I have been waiting for this call for a long time. Like I have a few others booked, but this one is really interesting to me because I've been wanting to break into this industry for a few months. I bought like a ton of even biographies about people that have done M&A before. It's super, super interesting to me because I've been very entrepreneurial. It's not really the main focus of my channel, but it's very interesting to me. And I like to kind of guide my channel based on what interests me. And it really, if I could describe what people in the M&A world do, is you're skipping the risk of a startup. You're literally skipping all of that. And I think it's pretty cool that you can do that and still get to be an entrepreneur. So, but going to your story, because that's what we really want to touch on in the interview. What I ask, this is something that I ask everybody that I interview, and I want you to tell me a bit about yourself, like stuff about maybe your childhood. The first thing that comes to mind, something that says, oh yeah, that's Matt.
Yeah, no, absolutely. So I was born in Massachusetts. My dad's a university professor, lived in Massachusetts, age 0 to age 5, then lived in Michigan for 12 years, 98 to 2010. But I guess to answer your question, Alex, one thing I remember vividly about my childhood is always kind of having an entrepreneurial itch. So when I was younger, there was this event that took place every summer in Ann Arbor, Michigan, called the Ann Arbor Art Fair. And essentially what it was it was a street art fair where you would have artists from across the United States would come there to display their art, some of it purely for display, other ones to sell it. And my friend and I, after going to this as young kids, we realized you have vendors there that are selling things, hot dogs, lemonade, beers, water. And we thought to ourselves, we're young kids. We want to make some spending money to have it to buy Pokemon cards and baseball cards and stuff. Why not just kind of opportunistically find a way to do this ourselves? So my parents were always kind of hands off when I was younger, just let me do my thing as long as I wasn't getting in trouble. So me and my friend, we went to the grocery store. I think it was Meijer or Kroger in Ann Arbor, and we bought 200 bottles of water and filled up 2 red wagons and just brought them into the art fair. And essentially we were undercutting our competition by the order of about $1 on each of these bottles of water. So I think the street carts or like the tents were selling them for 2. We were selling them for 1 or like just undercutting them. And we made a couple $100. And we did this for 2 days. But on the second day, we got kicked out because someone actually came up to us and confronted us and said, hey, you kids don't have a permit. We need you out here. So we had to go find some random person that had a phone, because this was like in the early 2000s. I didn't have a phone to call my parents to come pick us up. But to answer your question, Alex, that's a early childhood memory kind of relevant to what I'm doing now.
That's such a nice entry into entrepreneurship. I have noticed a lot of entrepreneurs get into just entrepreneurship just to random. This is totally not the way to do business stories. Like my first brush with entrepreneurship was I got basically from a liquidation event. I got like cases and cases and cases of alcohol, like liquor, champagne, and I got them for free basically, except that I had to transport them myself. And then I sold them to my friends for like 80% price because they, could get them from other places, but much more expensive. And that was my first brush with entrepreneurship.
That's awesome. Good for you.
I was much older than you though when this happened. I was much older. I started far later.
Okay. How old were you, if you don't mind me asking?
I was 18 or 17. I was 18, I think.
Okay. Yeah, everyone gets in the entrepreneurial ebb and flow at a different age. So
yeah, but I feel like the earlier you start, the better. And like, do you have, I'm sorry to ask, but do you have maybe I don't know, maybe you don't want to publicly say this. Do you have a family? Like, do you have kids?
Yeah, so no kids now. I'm married. I have a wife. That's it. So I've been married for coming up here on a couple of years. So 3 years here this fall. So no kids yet.
Yeah, I always wondered because now I'm 25, not old, but I feel like kids may come within the next 6 years. And I'm thinking, how do you instill ambition and entrepreneurship in your kids? How would you imagine you would do that?
Yeah, so I think it's something where it's learned. You see people doing things and it either seems appealing or it doesn't. And like I think part of it comes down to intrinsic motivation and just kind of what drives people. So naturally, if you think about it, Alex, like there are some people that are just fine working W-2 jobs, and that's perfectly fine. There's nothing wrong with it. But then there are some people that kind of have a higher propensity for risk. And I think part of it is nature, and I think part of it is nurture. I don't think people are born entrepreneurs. I think some of it is like you have a friend that you see is doing it and it just seems interesting to you, or maybe you read a book or you watch a movie or something like that. So to answer your question, I don't know if you can really completely teach it. Like they have entrepreneurship classes in schools, high schools, college, MBA programs. But to some degree, I personally think it's a combination of nature and nurture. Like if you're born and maybe you just have you're very conservative as a person, taking an entrepreneurship class isn't going to make you go out and want to be Elon Musk or Jeff Bezos, if that makes sense.
Yeah, Elon Musk, even like after his exit on X or PayPal, he put up all his money in his next company. Like most people would not do that. So when you say that you really have to kind of have that in yourself, I totally agree with that. Most people would not be willing to take some of these risks. And this is one thing that I loved about you. On your Twitter, you always say, hey, entrepreneurship or buying a company may or may not be for everyone. It's perfectly okay to have a good job and live a normal life. I love that because I feel like sometimes the entrepreneurial space kind of tries to push down entrepreneurship down everybody's throat, and it definitely is not for everybody. It's a hard life. I've been on both sides of the fences, sometimes freelancing and sometimes having a job. Right now I have a job.
Right.
And yeah, it's
Yeah, they're not to make a joke here, and I don't know if this is something that gets in, but I mean, there are enough things that get pushed down people's throats. Entrepreneurship doesn't need to be one of them. But I digress. I mean, it's honestly it's not for everyone, just to be frank with you. So
definitely not for everyone. So you had your first brush with entrepreneurship when you were young. Then you went to high school, and then what?
yeah, so I went to high school. Actually went to school right across from Michigan Stadium for 3 years, which is kind of cool. Played football my freshman year, figured out I wasn't cut out for it. There were 110 kids in my football team. It was like a high school of 3,000 people. And I was like a third string left guard. So just picture 90-pound Matthias playing left guard at age 14. Maybe as 100 pounds as a skinny guy. But yeah, went to high school, then moved to the Madison, Wisconsin area, went to University of La Crosse, so on the Mississippi-Wisconsin border, western side of Wisconsin, my first year of college, transferred back from there to University of Wisconsin-Madison, and then graduated from there a semester early in December of 2014. And went into SBA lending, working in a middle office capacity at a bank headquartered of the Madison, Wisconsin suburb market, working remotely for them from their Madison, Wisconsin office.
You're gonna have to explain to me what middle office means.
Yeah, great question. So in banking, you have the lender, kind of like the face of the bank that goes out there and they source the deal. So they either can find it directly themselves, which a good chunk of people do, or it comes from someone that refers the deal to them, kind of like me and Pioneer Capital Advisory, who I do now. So then they work closely with the underwriter to essentially get everything that's needed as far as the financial package for the business plan, the credit write-up, the projections, essentially everything the analyst would need. Then the analyst brings it through, puts it together, the credit memo. Depending on the size of the deal, that might get vetted out by 2 credit managers. Maybe it's 1 underwriter sign off, or maybe it's a full credit committee. Best case scenario, deal gets approved. Then it gets assigned to a loan closer, which is the role that I was in middle office. So since it's like the middle part of the assembly line, the closer takes it from approval all the way through closing and funding. And then after that, it goes to the portfolio manager that oversees the long-term relationship with the bank and the client. And so that's the kind of the back office. So essentially it's the front, middle, and back is essentially kind of where you sit on that assembly line, metaphorically speaking.
It's quite a much more complex process than you would imagine, to be honest.
It definitely is, Alex, but honestly, part of it has to do with efficiency. So the banks that are doing lots of these SBA loans, if you had the lender also underwriting it and also doing the paperwork execution, and then also fielding phone calls every time a business owner wanted to get a house release from the loan or get a vehicle release, honestly, nothing would get done. So that's the model at some of the smaller banks. But as a byproduct of that, it's harder to grow. So if you think about it, it's like when you play a sport, or maybe this is a bad analogy, but let's say that you play sports growing up and you play hockey and you play football. And if you're training for both of those, you can only get so good at one of them, right? Like at some point you have to choose what you want to do. And refining and really getting specialized knowledge in one of those areas makes you an expert. It makes you good at it. And as a byproduct, it makes the whole process more efficient overall. So
yeah, I totally get it now. So specialization over generalization definitely makes sense, that it makes everything much more efficient. So then you worked at the job for, I think it was 7 years, if I remember correctly.
Yeah, and this was, I guess, just a preface for anyone listening. So this was 4 different banks over those 7 years, not just one, but just not spend too much time going to minutia detail. Yeah, four banks in total, primarily working in middle office roles.
How was it? Did you enjoy it? What did you like about it? What did you not like about it?
Yeah, it was good. I obviously would not be doing this if I had not done that. So I'm nothing but grateful to each of my former employers and bosses. With that being said, so there are pros and cons of everything you do at every employer that you're at. Some have more friendly cultures. Some of them are a little bit more uptight and more conservative. Some of them you kind of vibe better with your coworkers than others, just based on personalities and the like. Others, you might have some lazy coworkers or people that there can be friction with. So I guess to answer your question, I mean, I'm grateful for the experience I had. At the end of the day, kind of part of the reason for doing what I am now is just kind of having more direct control over your destiny, both economically, financially, and just from a trajectory standpoint where you can really kind of lead your own path and do what you want to do and not be confined to doing one thing or told how to do it.
I get it. I totally get it. I totally get it. But I wanted to ask you also, what was the start? How did the start of Pioneer Capital? So are you, well, first off, are you the 100% owner of Pioneer Capital?
It's just me. Yep.
So how did this start look? How did you bootstrap it? Did you use maybe your savings from the years of working in a career? How did this start look? Did you already have the network, or did you have to go out and build your own network at that point?
Yeah, no, absolutely great question. So the way the seed let me backtrack. So when I started at my last employer, it was a great bank, bank called First Business Bank, based at Madison, Wisconsin, top 50 SBA lender. Thank you, First Business Bank, if anyone's watching this, for employing me there. I got introduced to SMB Twitter the day I joined the bank. So an attorney that I used to work with, his name is Scott Oliver, fantastic guy, even better tweeter than attorney. He introduced me to SMB Twitter the day I started the bank. So on LinkedIn, when you post a new job, it pings your whole network unless you flip a switch in there. And it basically says like, hey, Alex or hey, Matthias has a new job. So Scott saw my notification. He reached out to me and said, hey, Matthias, congrats on the new role. Best of luck. Wishing you nothing but the success. Hey, there's a space on Twitter of all these entrepreneurs looking to buy small to medium-sized businesses. You should join this space and start networking with these people and hopefully bring business to your bank. So I started doing that, kind of took like a fish to water and just started posting out on Twitter stuff related to acquisitions, banking, SBA, and whatnot, and meeting all these people. As a byproduct of this effort or these efforts, I essentially started generating leads for my bank and sending people to them and connecting them with loan officers at my former bank, First Business Bank, and starting to kind of generate business or generate lead flow. Around the same time, I made the dumb mistake of retweeting a tweet from my bank. And after doing so, my marketing department caught note of my Twitter presence, and it kind of started to go down this rabbit hole of sorts. Think of Alice in Wonderland analogy. And essentially, even though, so just to kind of fast forward, so as generating these leads through the bank from all these people as being on Twitter, connecting them with loan officers, even though all of this was going well, and I won't go into numerical specifics for this video, what ended up happening was things kind of cascaded towards the 2-month review that I had around the start of May, where I basically got told by my boss, hey, you're doing a great job. The lenders that you enjoy, or the lenders that you've worked with, enjoy working with you, but your Twitter is viewed as a distraction for the bank. Even though I have a pinned tweet on it saying anything on here is my own views, not the views of my employer. And I basically got told I either had to get off of Twitter or I had to stop tweeting anything about banking, SBA, and acquisitions. So going back a month before this, I was visiting New York, visiting a friend from high school. It was my first trip to New York, very beautiful city. And I'd started kind of bopping heads. Maybe it was a couple of weeks before that, I think. It was towards the end of March, if I remember correctly, with my compliance department. And I was talking to this guy at the airport in the United Club, I think it was in O'Hare, and we were just talking, kind of shooting the breeze. And this is an older guy, Vietnam War veteran, and we were just talking about what we did. And somehow my whole compliance dilemma came up, and he said, if I was you, I would go out and take a shot on yourself. You're a young guy, you have everything to win and nothing to lose. And so that kind of planted the seed. And so I was carrying that thought kind of with me just in the back of my head. So I got to my 2-month review and this started cascading. That's kind of when the spark got lit. So the day after this, I was on a plane with my wife to Greece for a 2-week vacation. So we did Athens, Santorini, Crete, and back to Athens. And if anyone watching this has never been to Greece, if you're ever able to go, I highly recommend it. One of the most beautiful countries in the world. Well, in Greece, I was waking up every morning, going to sleep every night, just stewing over this predicament I was in and just kind of how I disagreed with my bank philosophically and morally on this specific issue. And I thought to myself, here's this market of all these people on Twitter that are looking to buy small to medium-sized businesses here in the next decade. You've probably heard people posting about the silver tsunami, once in a generation, baby boomers retiring. This is not going to go anywhere. And I thought, I genuinely want to help all of these people, or as many as I can, with buying these small businesses. My bank has made it clear if I stay here, I can in no way, shape, or form do that because they want me off of Twitter or I have to stop posting about this. Then I thought to myself, based on the bank I'd been at before, Live Oak, Byline, First Business Bank, Bank 59, which used to be called First Bank Financial Center based in Milwaukee. Each of these banks, there's kind of a revenue channel that exists in the SBA marketplace whereby banks pay people to refer deals to them. Depending on the bank I had been at, anywhere from 2/3 to about 3/4 of deals I worked on came from such a channel. So lots of these lenders that are doing really good volume have 4, 5, 6 people like me that just send them deals. Some of them that are superstars just find them themselves, but that's honestly more rare. So I thought, here's this established kind of revenue model. Then lastly, I kind of thought to myself, I've worked at some of these banks, two of which are top 5 SBA lenders, Live Oak Bank, Byline Bank, and then these other two as well. And I've had coworkers that have worked at each of these banks that have gone on to different ones, like Huntington Bank and others as well. And I've stayed in touch with these people. Each of these banks has their own fundamentally different credit box of what types of deals they want to approve and what types of deals they don't want to do based on the industry, the debt service coverage, the background of the buyer, the amount of down payment that they have to come to the table with, the collateral of the deal, and things like that. And so I thought, here's this convergence of 3 things. You have a market of people, i.e. Twitter. You have a revenue model. And then you basically kind of have the knowledge that I built from being in these different banks. So I thought, with the convergence of these 3 things together, there's a way to go about doing this type of business that exists kind of out there, but in a different way, kind of going to market through Twitter, using specifically the middle office knowledge that I have on how to actually execute the deal faster once it's been approved to accelerate that. So while I was on the island of Crete, about 2/3 of the way through my trip, I just thought to myself, if I'm going to do this, the time is now. So fuck it. Why not just take a leap? And so I just put my notice in and just quit my job effective immediately to start my current company. And now here we are.
That's a lovely story. That's a lovely story. When did this happen? When did Pioneer Capital start?
Yeah, so it was the middle of May of last year. I want to say it was May 15th, May 16th, something around there. So we've been at it here for almost 9 months. So
that's good. And I guess now you got a pretty good picture of how it worked out. And I'm getting the idea that you're pretty happy with the decision you made.
Yeah, no, in all honesty, I am happy, Alex. When I quit my job, for full transparency for yourself and anyone listening to this, I honestly thought it was 50-50. 50% it works out, 50% it doesn't. And I thought, I'm going to give myself through October, November, see how this goes. If it doesn't go, maybe I reevaluate things, get a new job, go to business school. I don't know. But yeah, it's working out pretty good. So
does all of your business right now come from Twitter?
With the exception of one deal, every single other deal has come from Twitter.
Wow, that's crazy. Twitter is so powerful. It's crazy how powerful it can be. LinkedIn too. Have you tried LinkedIn for it?
Yeah, I have tried LinkedIn. For me personally, it hasn't really been that good. I mean, just anecdotally speaking, so I have this CRM with Twitter. It's called Black Magic, and you can see kind of essentially how many people have viewed your Twitter in the last couple of months. And just to share my dashboard here, I don't know if it will let me do this. This is my Twitter, and I have 7.1 million impressions in the last 3 months, which is insane. So,
wow,
and on LinkedIn, it's a small fraction of that. Now, that very well could be because I place a lot more time and effort on Twitter, which I'm sure probably is the case. But anecdotally, for me at least, I just find it to be a lot higher kind of use of ROI from a time and output quotient.
Yeah, I've heard I have heard that precise thing from a lot of people where Twitter simply is higher ROI. For some reason, LinkedIn can sometimes be a bit, I guess, sterile would be a half decent word for it. But
I think Twitter, so like, I think LinkedIn, you have the same people there, but it's like you feel like you have to have the dress shirt on in your posts, if that makes sense, because it's a professional network.
Yeah.
And then Twitter, it's kind of like, dress shirt comes off, or wearing tank tops and boxing gloves are off now. And it's like, just, it's all out there, right? Like, if you have something to bitch about, it's out there. Like I've seen I've seen the court of public opinion go down on Twitter, not in the same way as LinkedIn, because everyone's just a little bit more buttoned up, if that makes sense.
Yeah, you're right. It's definitely a bit more buttoned up on LinkedIn. I'm so happy we kind of went over your story and how you got here. I think it's a great story of how you started out being a career man and then figured out there's an opportunity online, and now you work at this. Actually, one more question about Pioneer Capital. Do you do this fully remote?
Yeah, so I guess your question is like, where am I based, or where do I work?
I mean, I'm obviously you can still no. My question is like, are you guys working from home and basically and mostly or entirely online? And
Oh
are
yeah,
you
so I'm not in this boardroom behind me. Yes, I am working from home. I could do this job from Antarctica if I had like Space Link or like Wi-Fi there. But to answer your question, sorry to be sarcastic, I do work from home. It's fully remote.
That's lovely because the question, if I only asked you, are you working in an office or whatever, I guess you can still rent an office or get a workspace if you want to. But I think it's amazing that you're able to source all of your business and do all the fulfillment remote. I think you even hired people from other countries as well, right?
Correct. I currently have three people working for me, all of whom are in the Philippines. So I have a guy kind of out there scouting deals using some proprietary tools to do it. I won't go into too much detail, but he's basically kind of working to get me at bats with people looking to buy small and medium-sized businesses. I have a guy that has experience working in commercial banking at JP Morgan that's doing lender decks and some underwriting for me. And I also have a closing operations manager, also based in the Philippines, that comes with former SBA experience. And her job basically is to kind of turbocharge and accelerate the closing process.
That's awesome. I think I've asked you on Twitter, but just for the sake of the interview, you are sourcing these great hires from what I've seen on your Twitter through Indeed.
Yeah.
You just go on Indeed and you post a job, and I think that's crazy. How do you hire them as contractors?
Yeah. So they're all contractors. They aren't like W-2 employees or anything. So I without delving into too much of my hiring process, they have certain websites you can use to give people tests and to gauge competence in different areas like English speaking, Excel, financial modeling. So the people that I had apply on Indeed, I use this additional filter to kind of rank them and see on the hierarchy who the most competent and best fits were for these various roles. Without sounding sarcastic and taking any sort of slight at the armed services, thank you, veterans. I'm trying to build the equivalent of the Navy SEALs over here from like an SBA or acquisition standpoint. So I need to have people on my team that can hold their breath underwater for 20 minutes, metaphorically speaking, and just help execute very efficiently and quickly.
I love that. I love that. I actually gave a lot of thought about what business I'd like to run. And I've been thinking about this for the past few months. And the exact same concept it just stuck in my mind. And it's one of my main criteria. I don't want a big team. I want a small team of really, really good people.
Right.
I think it
Yeah.
makes life
If you have one bad apple, it brings down the house, right?
definitely, definitely. I also had a few questions for you that are more targeted towards like, well, they're kind of questions I would like to know as a potential future buyer in the next 18 or so months. One of them, because I'm hearing different like definitions of what a small business is, of what a medium business is. I know now you're only doing deals that require at least $1 million in debt. But how do you define a small business and how do you define a medium business from revenues, EBITDA, evaluation perspective?
Yeah, absolutely. So SBA has this document. It's called the Small Business Size Standards document. I can share the link with you. I don't know if you'll put it in the comments for this, but
Yeah.
essentially based on the NAICS code for company in the industry it falls into, there's a different hurdle or a different criteria to determine if it's small. So for some businesses that might be sales or revenue, where the aggregate sales of your company needs to be under a certain size, like the company you're buying. Others, it might be employees. It just depends on the industry. And that's kind of the criteria primarily for determining if it's a small business. Now, there's some more nuanced stuff, which just for the purpose of the call, I don't want to confuse any viewers, but if you have other companies that you own 20% or more of, or that you can control by, basically having voting rights in the operating agreement, bylaws, things of that nature, those are called affiliates. And then the SBA looks at everything holistically, and they're looking at, there's a different size standard that gets used based on affiliation. So,
okay, that's much. I expected it to be a bit similar, but I guess the link that you're going to share would shed a lot of light on this subject. I'm also curious, like, what are the sectors that you primarily target at Pioneer Capital, or do you just do anything?
Yeah, so I tell people, and again, this is kind of being a little bit facetious, is anything that's a for-profit business that doesn't involve marijuana strip clubs, or gambling is for the most part SBA eligible. There's some nuance to that, but generally speaking, it's a good kind of proxy to go off of. For the most part, when I talk with people, I tell them, look at businesses that are recession proof, that didn't get hit hard or nailed by COVID, and think about ones that aren't going to get disrupted based on where things are going directionally with the economy, like the shift to Amazon, what they might disrupt next. I tell people to avoid retail unless it's something very specialty. That's very niche, that has like a good local strong customer base. I could give some examples of that later. And then things like hospitality, restaurants, unless it's franchise, and even still, those can be pretty difficult too. So essentially recession-resistant industries that make money, that don't involve prostitution, gambling, or joints. That's kind of generally what I tell people.
Makes sense. It makes a lot of sense. Hospitality, you saying hospitality is really hard. I think I agree so much with that. I have, like, obviously I'm tech oriented, and if I'm ever gonna buy a business or start a business, for me, it's definitely gonna be online tech stuff. But I have friends who are not tech oriented, and they always think, should I start a hotel? Should I start a restaurant? And my father, he used to be a very successful businessman. He made his money in construction, and then he destroyed the wealth in hospitality. If I was a very short story, but yeah,
sorry to hear.
Yeah, it's fine. I think it turned out all right because it put me in a position to have to go out and make my own path, and it made me who I am today. I don't regret it 1%. But about hospitality, I totally agree. It's kind of a hard business to make work.
Yeah, no, completely. And it takes a certain type of skill set where, like, you either have it or you don't. And if you don't have it, you have to hire for it. And then if you're hiring for it, you're highly reliant on that person. And you need to make sure that that person's incentives are aligned, because some of these people can be very difficult to get. And if they leave, then you're shit out of luck and you have to go find someone else.
Yeah. What percentage of your deals are in tech? Like, for example, to give you a bit of a background on where I'm coming from, I used to work kind of, I guess, in SaaS, and now I work in Web3. I don't know what your opinions on Web3 are, whether you're positive about it or negative about it, but how many of your deals are actually tech oriented, like SaaS companies or anything in that direction?
In all honesty, Alex, not many. Lots of the ones I'm doing have been for trade businesses like air duct cleaning, HVAC, plumbing, companies like that. I've had a couple people that have bounced some of the tech deals off of me, but lots of times, especially just when it's a larger deal from like EBITDA, SCE standpoint, they tend to trade for higher multiples. And ones where the amount of SBA debt you can put on it to make it make sense just isn't palatable, or like something that the seller will go for, it's kind of a tough pill to swallow because either the borrower has to do a lot more equity, the seller has to do more seller financing, and essentially if you're expecting a big payout at closing, it's going to be difficult since the amount of the financing the seller gets is essentially the bank debt minus whatever the bank debt's being used for other uses of funds buckets like working capital and such, plus the equity from the buyer, if that makes sense.
It makes sense. How, like, since you've been seeing a lot more deals than I've ever seen in the tech industry, what are the multiples that you see, for example, in deals around the a million to say 5 million deal evaluation? What are the more, well, I don't know if that's a good question actually.
Yeah, like the million. So are we talking SC or EBITDA? So a company that's doing a million EBITDA to 5 million, what the seller is asking for as far as the purchase price?
Let me rephrase it so it's properly asked. Say a company has an EBITDA of half a million to maybe 3 million or somewhere along those lines. What's the usual multiple do you see in that? If you've had a lot of deals like that, if not, we can skip past this question.
Yeah, so I can't really speak intelligently to tech, to be honest with you, just given the fact I haven't worked on a whole lot of deals in the space. But anecdotally speaking, typically when a company goes over the 1 million EBITDA mark, the multiple starts to go up a lot. It's definitely over 4. Sometimes people are asking close to 5 when you're getting up to, like closer to the 2 million EBITDA mark. But also when there's recurring revenue contracts that are in place, like SaaS software companies where you have subscriptions, that drives the enterprise value up more. It honestly depends from one deal to the next, so it's kind of difficult to make a blanket statement.
Definitely, I totally agree that it's especially hard to make a blanket statement. But yeah, I've heard that SaaS, and especially if it's got like good quality revenue, they do have much higher multiples, sometimes past 5. And I think this is what you meant, and you can correct me if I'm wrong, but I think this is what you meant when you said that deals after a certain multiple, they start to be hard to kind of swallow and make work. And I'm thinking that kind of the max multiple where it's easy to make it and where it's very hard to make it work past that is maybe a 4 or 5-ish.
Yeah, I'd say like 4 or like over a tad over 4. I mean, anecdotally speaking, one of the banks I work with, which is a top 10 SBA lender, very well known. If I mention the name, people would recognize it. The rule of thumb they kind of have is that they'll lend 3.25 times of EBITDA. So if you have a deal where the seller is asking, let's say 4.5 for the multiple, the bank's lending 3.25, then 1.25 turns of the EBITDA as an amount has to come from somewhere. And that's going to be a combination of equity from the buyer and seller financing. So once that number starts to go up, since you have the bank constraint, the question is the buyer putting in more? Is the seller putting in more? Are we kind of matching, or how is that going to work?
Which brings me to my next question, which is how often do you see buyers create a deal structure where they themselves put no money down of their own, in the sense that they make the deal happen with debt, money from outside investors, equity investors, and sellers note? How often do you see somebody really put like 0 or almost 0 money down? Like,
yeah, good question. So there are some banks out there, or I guess let me backtrack, Alex. I'm speaking just specifically from the lens of SBA lending, since outside of SBA, there's more variation, more flavor that you can explore. In SBA lending, when you're buying a business and it's your first acquisition, you don't own any companies in that industry, you need to come to the table with 10% equity. So that's based on the total use of funds, which includes the purchase price of the business, plus any working capital that you're financing into the loan, You can have working capital, so cash, accounts receivable, inventory in the purchase price, plus any legal quality of earnings, due diligence costs, plus closing costs, plus the SBA guarantee fee. So the sum of all of that. So you have two different options you can do. So either one is you and your buyer group, so investors in your buyer group can come to the table with 10% of that, or you can split down the middle. Half can come from you and your buyer group, and the other half can come from a seller note on full standby, meaning no payments for the life of the SBA loan, hence the full standby hat. And you've probably seen the hat on Twitter, so you knew that was coming. But anyways, back to your question, there are some banks out there, and I won't name the names because that takes away part of my value proposition, that are fine with the whole down payment coming from investors in your ownership group. Those banks are few and far between, and they tend to be more selective on some other criteria. Now, the banks I tend to work with want to see at least, I'd say, 20 to 25% of the down payment coming from the person that's the personal guarantor. So the person that owns 20% or more of the business. With the reason being is that even though that's not required by SBA, they want to see the buyer has some economic skin in the game, because even though there's a personal guarantee, if the person has no money to fall back on and they have a weak personal financial statement, they have to go back to the investors and do like a capital call to get more money or something like that. It just puts the business in a bad spot. Now, one thing, just since we're kind of here on this call, while explain the full standby is a huge thing that I will have carved into my tombstone, is because it gives you as the buyer lots of optionality for buying a bigger business. So that's one thing. So basically, instead of taking the amount of capital that you have for deployable capital towards the down payment, multiplying it by 10, and that's kind of the total use of funds chart you can do. You take that same amount of capital, multiply by 20, all of a sudden you can do a bigger deal. Now, secondly, you preserve more liquidity on hand, and you have more cash in the bank post-acquisition to weather the potential storm. If you have, maybe your tires go out in your car, maybe someone in your family gets cancer and you have a big medical bill, maybe the business needs a big capital infusion. There's just the shit happens factors that you can't really put a dollar tag on. Now, another thing is the seller with SBA guidelines can only stay on for up to a year after closing. Now, you want your seller to be helpful with transitioning the business. There are two flavors of the seller notes, one of which is the full standby, the other one of which is any other type of seller note on which payments are made, and you can get creative there. With the full standby, your seller essentially is kind of in the canoe with you until the SBA loan gets paid off, because they have that money riding out there that they're getting accrued interest on at the time it gets paid off, but not before. So let's say you're buying a massive business, maybe it's a manufacturer, maybe it's an HVAC distributor or something, and your seller's consulting period is up, they've moved to Mexico, they've gotten their money, and all of a sudden something comes up with one of your big suppliers, and there's some detail that's somewhere on a shelf on some part of the business, or stuck in some thumb drive that you need to find, and you need to scramble, and the supplier says, hey, why don't you call Mark, your seller, and figure this out, he should have this. You call Mark is out smoking a cigar and drinking a margarita on the beach, and he says, go pound sand, I've gotten paid it's, this is all you now. Not to say that would actually happen, but it's a very realistic situation. And I know people that have been there before where the seller's just out. The full standby helps you eliminate that, because essentially the seller wants to eventually get those proceeds. So if something comes up after those 12 months, once the consulting period's done, they have that money riding along with you that they want to eventually get paid out on. So they're incentivized for you to not fail, which is why it's good for you. Lastly, if you have investors in your ownership group, they get a bigger return on their capital, because if you think about return on equity, it's a function of how much cash you put into the deal. the less cash, the higher return on equity. And so essentially, if you're looking at the exact same deal in the margin, you get a better return of a full standby versus not having a full standby. Lastly, from the lender's perspective, it makes no difference whatsoever on debt service coverage because there's no payments on the full standby note until after the SBA gets paid off. So it really makes no difference. Now, in reality, you're going to want to save for that balloon payment at the very end. So you have a couple different options. Is either one, when you refinance the SBA loan with any other seller financing, you could choose to refinance it at that point in time if there's a due and payable language in the full standby. But otherwise, essentially, when your loan comes to maturity, you're going to want to be escrowing away funds for that note so that it doesn't kind of smack you in the face at the very end. So I know I kind of rambled a little bit there, but just in case that's helpful.
This is super educational. So I have a few questions, and I'm hoping I can keep them in my mind long enough for you to also answer. So say I'm a buyer, hypothetical scenario, and I find an investor group. I convince the seller to give me a 5% full standby seller note. I find a small investor group which gives me, say, 3% of the deal. I put down 20% of the deal, so I got some skin in the game too. The seller gives me 5%, 90% comes from the loan. Usually, how much equity would I get as the kind of CEO of it all? How much equity would I get versus the investor group in the whole deal?
Yeah, great question. So typically, Alex, you would get more. So, and this is where there's some more nuance involved. So you can have two different classes of shares. You can have preferred equity and you can have common equity. And that has to do with essentially the time of the liquidation of the business, who gets paid out first, different rights in liquidation scenarios, things of that nature. Typically speaking, the searcher, i.e. you, the person signing a personal guarantee, would get more of the common equity. And then the investors would normally get more of the preferred. Now, the exact ratios and the exact breakdown comes down to how you model the deal specifically to get the investors to the multiple of invested capital, so the MOIC and the IRR, the internal rate of return that they require to make it be a good deal to them. But the actual economics tend to split out. So you ultimately will have more than 20% of the common, and the preferred will get spliced and diced, however it may be. But essentially, it all comes down to the deal. So I know that isn't super helpful, but it's hard to make a blanket statement.
I guess really if I could boil down this question in a I guess more answerable way, and in a also boil down to what I personally would care about as a searcher, would I be able to retain control of the company?
Yeah, so you would, absolutely. I mean, you would retain control because anyone that would, so if someone else was to have control in the operating agreement, they would be required to be a guarantor because that's an SBA requirement. So if they can make decisions on hiring and firing, loans, things of that nature. So you could have like an informal board of sorts, but you can't have someone that can come in and fire you, when you're the one running the business as the PG person. So
you rest assured you're gonna take at least 51% of the deal.
Yeah, and typically it's more than that. I mean, I've seen typically like 80s at least, I'd say, but it all depends. Like it's hard to make a blanket statement because if you're putting in close to nothing and the investors are putting in a lot, they very well may want more of the pie, but it just kind of comes down to how it gets modeled out.
Yeah, definitely. It makes sense that this is very specific to the deal and the specific structure. So I'm curious, when you talk to a is a searcher the proper term for somebody like me that wants to ultimately buy a business?
Yeah, searcher, independent sponsor, entrepreneur, tired of working for the for the man, whatever phrase you want to use. So I'm agnostic to what people want to call themselves.
What do you look for in an entrepreneur that would potentially become your client?
So I would say first people that are serious about going through the process. So like typically when I get involved, it's after someone has a sketch of what their letter of intent would be like before they submit it, because then I can make sure that that validates out and that it would actually have a good chance of getting approved, and I can pre-flight the deal with some of the lenders I work with. But from my perspective, someone that has transferable skills to the business they're buying, they've put thought into it, specifically why they're a good fit to run the business. They either have the modeling chops and have modeled it out before they connect with me, or if they don't, there's a good confidence level on my end that if I'm putting time in doing it with them, helping them out, that they're going to work with me, or maybe they have someone else that's kind of helped them. And then people that have their investor base either kind of lined up or they have a pretty good idea of where it's going to come from, but ones that are kind of far enough along so that maybe there's a couple of balls or batons up in the air, but once those fall into place, they're kind of ready to get underway, if that makes sense.
Sounds good. Basically, competency, pretty much.
Yeah, competency and sincerity, and people that know that this is something they want to do. People that I don't like to engage with are ones where it's like, hey, I hate my job, and like, here's the business I found on Biz Buy Sell. Can you run this through an Excel spreadsheet and see if this works? And if it does, how much would a bank lend on this? Can you get me approved at 5% interest rate? Where can I get no personal guarantee? Like stuff like that. So
I don't think they would. Yeah, I would. Me personally, I would get pissed if somebody contact me like that, because I mean, you can just napkin math on your own.
You'd be surprised. I mean, I get people that reach out and it's like, hey, I'm working with bank XYZ, and they've basically told me they don't like my deal. And I have to close in 15 days. Can you deliver? Like things like that. And then I've had people that reach out and they're like, hey, I have a signed purchase agreement. I need to close in 3 weeks. Can you help me? So like it's people all across the board. Some people are more sophisticated than most. It really just, it depends where the ball falls.
Yeah. Yeah. You mentioned 5% interest rate. What's the usual going interest rates or the range as of this very moment, February 2023?
That's a loaded question. So SBA loans are tied to prime. Prime is currently 7.75%. Speaking anecdotally, I've seen as low as prime plus 1.5 for a really strong deal. Very atypical. As high as prime plus 2.75. At this time, SBA allows up to prime plus 3, so that'd be 10.75. Most of the deals I see typically are in like the prime plus 2 to prime plus 2.5 band-ish. But with that being said, it all comes down to the deal. So it's really hard to make a blanket statement.
But I mean, my blanket statement that I take from this is, hey, if your deal can stand at 11%, you're probably going to make it through.
Right. And just to kind of add on to that too, Alex, some of these banks, or lots of them, are stress testing these deals, because right now, Jay Powell's kind of an Tommy gun or bazooka, or pick your analogy. You see these fun gifts out there on LinkedIn and Twitter with him just kept shooting $100 bills. But it's very real that just given the inflationary headwinds that we're in, if the Federal Reserve Board of Governors decides to raise rates yet again, and you can see what the futures markets are predicting out there, banks are stress testing. I'd say some of them that I talked to, 100 basis points over and above what the rate is. And so essentially they're looking at, this is Alex's rate if he borrows from us in the SBA loan, but this is what we think prime might go to, and this is what his rate would be. Is his deal in the green or the red if it hits that? And if it's in the red, then no deal, do not pass go, do not collect $200, go back and redo it. So
Are fixed interest rates common?
Not really, but the reason being that lots of these banks sell their loans in the secondary market. And lots of these, so given the facts we're in a rising rate environment, most of these SBA secondary market buyers don't want to buy fixed rate SBA paper, because if you buy a bond, which is what these SBA loans are, and they can only get sold to one buyer, which is a very niche thing, but it's just how the secondary market works. If you buy at X interest rate and rates go to X plus one, then it's like you would have rather just waited for rates to go up and just have not bought. So there are some banks I do work with that will portfolio their SBA loans, and that gives them flexibility to do either fixed in increments, and some will do fully fixed, which is more rare than common. The ones I work with that do fixed, like I'm seeing fixed for 3 years, fixed for 5 years, fixed for the whole life of the loan. But anecdotally speaking, they will charge a premium for the fix, and that has to do with the period that you're fixing it in for. Now, with that being said, if you think that we're close to the top of rate hikes, and say that rates stabilize this year and then they start to go back down, do you really want to pay that spread over prime if you could be locking in towards the top of the rates? Or do you want to gamble and then potentially in a couple of years, maybe just refinance of the SBA? Because if you're buying an SBA, if you're buying a business with an SBA loan and it's just the business with no real estate, there's no prepayment penalty, you're just required to give the bank 21 days notice or 3 weeks of notice so they can notify the secondary market investor if they sell it, and do all the stuff on the back end before you pay them off. So
what I have seen, and again, everything that I know is solely from books and from Twitter. So my information may always be off, but
Twitter's a great way to learn. So I learn new stuff every day.
It is. Do you think it's accurate to say that 5 to 10 year term deals are common?
For 5 to 10 year term for like for what? Sorry, for like the seller note or for like the bank loan?
I always thought the seller note is probably max 5 years for some reason. I was talking about the debt right now, but both. Let's find out about both.
Oh, got it. Okay, yeah, good question. So SB loans, when you're buying a business and there's no building being attached to it, it's always going to be a 10-year term loan, fully amortizing. So essentially, the way I explain it to people, and this is kind of dumbing it down because there's more nuance involved. Excuse me. When you buy a business and you use SBA financing, as long as you're making your payment on time, and as long as you're giving your annual personal financial statement, annual personal tax returns, annual business tax returns to the bank, and anything else that's required, it's set it and forget it, essentially, more or less. Now, there's some nuance to that, like if there's specific requirements in your loan agreement that you need to abide by, or if you change the ownership, there's approval that gets involved. But more or less, kind of set it, make your loan payment, you don't have any worries. With conventional non-SBA loans, there's covenants and things like that riddled into them, where for one, most of these loans are not fully amortizing. So it might be a loan where it comes fully due in 3 years, 5 years, 7 years, whatever is negotiated in the note and the loan agreement with the bank. And then further, there can be specific financial hurdles that you have to meet. And God forbid you don't hit said hurdle, all of a sudden you have to go and refinance with another bank.
Wow, that wouldn't be fun, I guess.
Yeah, definitely not fun. And I've worked on a good number of deals actually where the client was in that exact position where they were getting forced out of their bank, not because they weren't making their payments, but because the underwriting criteria were such that maybe they were breaking debt to net worth requirements or things of that nature. And lots of these larger banks, even regional ones, not national, they just have a more conservative criteria, and you either fit in their box or you don't, and you can't fit a square peg in a round hole. So
yeah, makes sense. What's in your experience a common deal breaker?
That's kind of a loaded question. So like something that could blow up a deal after it's been approved, or like something that would make a deal not get approved?
Um, let's try both.
Sure. So I would say, trying to think here. So say you get a deal and it goes to credit committee and the person has, or it won't even go this far. Let's say you get your credit report pulled and you have a bankruptcy that you didn't disclose to a bank. Now, a bankruptcy is not a deal killer as long as you have not defaulted on federal debt. So if you default on federal debt, you're effed, and essentially do not pass go, do not collect $200. You have to cure that before you're eligible to borrow again from the government. If you do so if you had that bankruptcy and you did not disclose it to the bank, which is a big red flag, that's going to derail the train. Some banks will order due diligence searches on the buyer, like abbreviated ones as part of their underwriting before it even goes to the credit committee. So something like that, essentially, if something hairy comes up in those, maybe you had a felony, maybe you had a misdemeanor that did not get disclosed, that can also blow the deal up. So the story here is to be upfront and honest with the bank. If you have a felony, essentially, unless you can get cleared, it's not going to be possible to get SBA financing. If you smoked a joint walking across your campus in college or university, and you got a misdemeanor, everything will probably be fine. You just gotta have to mea culpa about it and just make sure you have the paperwork to get it cleared. So
Makes sense. Makes sense. What about after the deal is approved? What's a common deal breaker then?
yeah, so after the deal gets approved, I would say things that I've seen that have derailed deals would be one, deteriorating seller financials. So say that you have a business under contract and the financials, different banks have different requirements. So one might say they want it to be, the seller financials need to be within 90 days of closing. Another bank, it might be 30 days, that'd be the more conservative subset. Some it might be 60. If there's a big material change in financials from the time you had presented them and went through underwriting to closing, that can derail a deal depending on the bank, depending on the circumstances. Similarly, let's say just hypothetically, the due diligence stuff with the searches, things coming up, surprises of that nature. Maybe you had a felony, maybe you had a hit and run, something like that. That can derail a deal. Surprise bankruptcies. Another common one is landlords that are difficult. So if you're buying a business, if the business is required to have a lease, say it's a very location dependent business, maybe you're buying a plumbing company and there's only one building that has the functionality that you need within a certain radius of the market of said property. And let's say that the landlord, let's say you're buying the business, the goodwill or the assets, and the landlord will not sign what's called a landlord agreement that gives the bank the ability to access the collateral if the loan defaults. That can be an absolute showstopper and that can blow the deal up. So there's things of that nature too. So essentially, one of the things I tell people is once the LOI is signed and they're in underwriting, try to get a hold of that document as soon as you can from your bank to get in front of them. Because if you think about it, if you're a landlord, you don't really have economic or financial consideration to sign said document other than getting continuity of the rent payment from the new tenant versus if the seller just walks away and closes the doors. So you have to think of it from the other side of the bench. If you're them and you have the document being forced in front of you at the last minute, how are you going to react, essentially?
Yeah, it makes sense. Do a lot of deals fall out after they get approved, or do most of them end up doing all right?
Most of them go well. I'd say like 90%, probably even higher. But like even in that 90, there's like many that have these bumps in the road, close to the end. The difficult landlord, things of that nature. One of the investors maybe gets cold feet and backs of the ownership group, and they have to pull someone else in. Maybe someone can't get approved for life insurance because of a health issue, and then they have to pivot and find someone else or like get a decline letter. There's always, there are very rarely any deals where it's like a smooth kind of sailboat going across the lake. Few are like kind of going bump, 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 but like some of them, it's like you hit a little pothole and you just have to find where that strut is to get your car to bounce out of it. So,
what advice would you give someone that wants to buy a business in the next, say, 18 months?
yeah, I would say honestly, think about first what you're passionate about, because a business is a long-term investment and something that you're going to be attached to potentially for a lifetime, up until you retire or you die, not to sound morbid. And you want it to be something that you're excited about going to work to do. So like for me, I'm very excited to do what I do. I can't imagine doing anything else right now. And I'd say don't buy something just because everyone else is doing it, like the HVAC, the plumbing. Buy something that you're passionate about, because at the end of the day, if you aren't passionate about it, one, people will be able to tell that, both clients and customers, clients, customers being the same, so clients, employees, and two, you just aren't going to feel motivated at some point to get up in the morning. So think about the same reason why you're quitting your job. What is it that inspires you? If you could pick, have optionally across different industries, what would that be? What was that thing you were passionate about when you were a kid that you wish you'd done? Kind of that sort of thing, not to sound corny. And also, where do you see an alignment of your skills with these different industries? And finding kind of the marriage of those two, I think, is the American dream.
I think that's very good advice, because it seemed like it would be quite miserable to be locked for 10 years into a loan for a business that you don't even at least kind of like. It wouldn't be fun.
100%. I mean, it'd be like being in jail. You had the personal guarantee out there. I'm being a little facetious here, but yeah, it's not ideal by means. So,
what's the most interesting deal you've helped close? Like the most, I don't know, creative, fun, weird, satisfying? Like what pops to your mind when I ask that?
yeah, so I mean, I obviously can't divulge too many specifics just for confidentiality purposes, but I had a guy I worked with that was 25, 26, bought an air duct cleaning business, only had a couple years of experience out of university in private equity investment banking. And basically he got his friends and his family to buy in and kind of take a ride with him, where they did the lion's share, the majority of the down payment. He did very little, and was able to get them on board, sell his story to the seller and convince the seller why he would be a good person that can be the new operator and take the lead of the company. And just everything involved in that deal was very not only interesting and inspiring, but just educational, both from how he structured it, how he related his background and what he saw as the market opportunity, and just other kind of adjacent parallel things to that, if that answers the question.
It can be done at 25.
Yeah, yep, it can be.
I would assume the SBA is only really available for people within the US.
Correct. Yeah, so the yes and no. So the criteria is that the ownership group needs to be at least 51% US citizens or green card holders. So if you're, and I've actually had people reach out to me outside the US, from all parts of the world. So if you want to buy a business in the US, you essentially need to find someone that checks that box, that has the US citizenship status or the legal permanent resident status, if you're outside the US and a non-citizen. So it's possible. It gets more difficult because even though it's allowable, banks like to see people that essentially have that, so that they can't, there's less risk from the bank standpoint because you have people that are kind of boots on the ground here stateside.
Yeah, it makes perfect sense. To wrap it up, This is the question that I also ask everybody. I was going to ask you a few more questions about what you do, but I think this wraps it up well. Any advice would you tell your younger self?
I would say, and this may sound kind of corny, I would say be ready to take chances and take risks. I think lots of people, including myself, potentially could have maybe even done this a year sooner, hypothetically speaking, had I known about the SMB Twitter space. But I think a lot of people, including my younger self, kind of tend to look more at this. You get one track minded, you're in a career, you see the progression. It's like, you move from this level to that level, then you hopscotch to this and you go up to that, and then you're doing this and shoots and ladders. And I think if you don't get so just constrained on one path, even in one industry, you see all the opportunity out there, whether it's taking a leap to be an entrepreneur or doing something else in the W-2 world, maybe in a different industry. That's something I say, just having more of an open mind, generally speaking, would be my advice to my younger self.